Welcome to Everyone Can Trade. To motivate us for more content, please like, share, comment, and subscribe to the channel.
Ever wondered how companies go public? How they transform from private entities into a corporation with shares that anyone can buy or sell? This journey, ladies and gentlemen, is called an initial public offering, or more commonly known as an IPO. However, it's important to remember that the price of shares can also go down after an IPO. Imagine a company as a pie. When a company decides to go public, it essentially divides this pie into millions, sometimes billions of tiny slices. Each of these slices represents a share in the company. An IPO is the process through which these slices or shares are first sold to the public. So why does a company decide to go public? There are several reasons. Firstly, it's a fantastic way to raise a lot of money quickly. This money can then be used to fuel expansion, pay off debts, or undertake new projects. Secondly, it can also be a lucrative exit strategy for early investors who now have the opportunity to sell their shares to the public. But how does an IPO work? Well, it all starts with hiring an investment bank. The company and the bank work together to figure out how many shares should be sold and at what price. This process is called underwriting. Next, the company needs to file paperwork with the Securities and Exchange Commission detailing their financials and business plan. This document, known as a prospectus, is then made available to the public. Once the SEC approves the prospectus, the bank and the company embark on a roadshow. This is essentially a marketing tour where they try to generate interest and excitement for the upcoming IPO. On the day of the IPO, the shares are sold to the public for the first time. The price of these shares can fluctuate greatly on the first day as the market determines the true value of the company. But remember, investing in an IPO can be risky. While there is potential for high returns, there's also a chance that the share price can plummet. Always do your research and make informed decisions. In summary, an IPO is the process by which a private company goes public, selling shares to raise capital. It involves underwriting, filing with the SEC, a roadshow, and finally, the selling of shares. It's a complex yet fascinating journey that transforms private companies into public entities. So next time you hear about a company going public, you'll know exactly what's happening behind the scenes. It's not just a business move, it's a pivotal moment in a company's life, a transition from private to public, and an opportunity for everyday individuals to own a slice of the pie. But what does an IPO mean for investors? Well, the lure of an IPO for an investor is the potential for high returns. If the company does well, the investor stands to make a significant profit. However, like all investments, IPOs come with their own set of risks. The company's performance can be unpredictable, and there's a chance that the stock's value could decrease after the IPO. As with any investment, it's crucial to weigh the potential rewards against the risks. Always remember to do your own due diligence before jumping into any investment, IPOs included.